Lord John Lee of Trafford, the UK's first ISA millionaire and long-time columnist for the Financial Times, has published his first book, How to Make a Million Slowly. He describes it as his financial autobiography, and in it he describes his successes and failures over 55 years as a private investor. So, why did you write the book?
I wrote the book really for two main reasons. Firstly, because I'm really evangelical about encouraging potential private investors to actually take their own decisions on investment rather than go through mutual funds or use advisors, to really take their own decisions. And secondly, because I wanted to share with them the interest and enjoyment that I've had over 50 odd years of investing, and I wanted to convey that sense of interest and enjoyment and excitement, and also obviously hopefully to enable them to learn from my mistakes.
Your investment philosophy has been long fused to buy and hold companies that will grow and produce a dividend. How do you identify these companies?
Essentially by keeping well plugged into the financial media. Clearly, the many sections of the daily papers. I read the Investors Chronicle and always have done at the weekends. Obviously, I talk to a number of people as well, and ideas are suggested to me. And then I do my own research. And I almost immediately go to company refs, which I regard as my Bible in many respects, where there is a sheet on each public company. And therefore I can look at that sheet and I can look at the directors, I can look at the profits record, I can look at the borrowing situation, I can look at the dividend yield. And that really enables me to form an overall view as to whether I want to seriously consider buying a stock or not.
What was your biggest Lee miss, the company that you sold too soon?
I have to say there have been quite a number, but I remember one particular one. Many years ago, I invested in an East Anglian manufacturing business that manufactured supermarket trolleys and related products. Just sat on the shares for a few months, convinced that something would happen at some stage. And lo and behold, along came a certain Martin Sorrell, who I'd never heard of then, and he bought a block of shares, and the shares shot up. Clearly, people took the view that he was going to use this as some sort of vehicle for his expansion. I sold, having trebled my money, I think, very pleased to make that profit. Today, Wire and Plastic Products has become WPP, an £18 billion global business, probably dominating the world of PR and advertising and media. Had I stayed aboard, I think I'd have been a very wealthy man today.
A lot of private investors don't have the time or inclination to get personally involved in companies as you've done. They don't meet the directors and they won't attend AGMs. Can they still be successful when investing?
Yes, they can still be successful. Even no reason why not. But obviously they'll need to do a fair amount of research and reading. But to me, I think one either really almost falls in love with stock market investing and really enjoys it, or one doesn't.
One of the things you cover in the book quite candidly is where you've made a mistake. How do you decide when to sell a poorly performing stock?
Very difficult, very difficult. First of all, I think one should put in what is known as a stop loss, so that if a share goes down after you bought it and goes down, say 20%, then I think almost automatically you ought to sell that share and take that loss on the chin. My biggest mistake, I would say, over the years is actually selling good shares, good stock, too soon and not staying with them. And therefore the number one message that I've learned in all my years of investing, and I try and bring out very strongly and forcefully in the book, is that investment is essentially of a long-term nature and people should be patient. The biggest problem that investors make is selling too soon.
There have been many variations in the tax wrapper world. Would you suggest investing in or out of a tax wrapper?
Extremely valuable to investors and to me. I really took advantage of PEPs when they originally came out in 1988, and for the next, I think it was 16 years, invested the maximum amount each year and also reinvested the dividends. And that's essentially how I built up a fairly substantial pot of money, pot of worth, of value in my ISA. So that tax-free wrapper, in the case of ISAs, free of income tax and free of capital gains tax, extremely valuable.